Hello, Business 630 students. This is Professor Hassey. It's week 5, our lecture video for week 5, the week of July 4 through 10. Problem is today is Sunday, July 10th, so Professor Hassey again got off to a late start. But you're working on a capital budget risk analysis spreadsheet that we posted last week and talked about in our last video, and I'm just going to update that because we're spending 2 weeks on this and going up talking specifically about the risk analysis today. And that leads us to completing the capital budget risk analysis, which is due this Friday, July 15th. Our subject of our lecture video in this upcoming week, which will be posted later on in the week, is on financial statement analysis, making sure we understand the financial statements and what they tell the financial manager in corporate finance. You'll have a case study, which will be posted at the end of this week, which will be due July 24th, which will be a financial statement analysis of the company that you selected that was the subject of your case number 1. You'll be doing a financial statement analysis of that company. But first of all, we're going to finish up our capital budget analysis and understanding and using this information to lead into future financial statement work. Is once we decide on how our financials are, then we talk about how we invest our money. So that's our subject for this week. Okay, let's take a look at our Blackboard currently. For our class, we're concentrating on week number 5. But before we look at week number 5, let's take a look at, just refresh ourselves with our schedule. We have July 15th, this Friday, case number 2. The next week we'll have case number 3. Then we'll have our course assessment case paper, which is a combination of APA and spreadsheet format, which has to do with capital budget analysis, but it's looking at the strategy of capital budget analysis. So we'll talk about that in another week or so. So we're in the last part of our class. We have 3 more case works to be completed. Case 2 this week, case 3 the next week, and then case course assessment case, which technically we probably could call case 4 the next week after that. So that's where we stand right now. Make sure you all are aware of that. And if you have any questions with your schedule, I know we have had some students like myself the last week or so who have had family health issues. I had a family member in the hospital and they're home from the hospital now, but this person is in Michigan, so I have to travel back and forth to Michigan. So that makes it a little difficult. And I know some other of our students are having medical issues. So please just keep me appraised of where you are, what you can do, what's your schedule like, and how you're committed or how you can be committed to this course. And any way I can help you with that, please let me know. So here's week number 5 this week. We're continuing our work with the capital budget analysis. We're going to talk about that in just a minute. Here's the review file, which is very similar to week number 4. I'm just adding a couple of other things to it in our discussion today. So there's that. Here's a PowerPoint of chapter 11, which also goes over risk analysis, scenario and sensitivity analysis, and you can see that. And also there's a couple of videos explaining it as well. So all to get you in good shape to complete your case number 2 work this week. And as I mentioned last week, this is very important to the study of corporate finance because it goes through the strategic review of whether you can get an adequate return on investment and and then it serves as a budget model or a review model or a variance model as the project goes forward. So let's talk about that in the spreadsheet. So let's bring that up. So remember, the capital budgeting process is a series of events that have to do with the use of accounting information, management information, distribution, manufacturing information, all to coming up with the numbers needed to make a decision about a company's investment in an asset. A key part of that is how much money you're investing in the asset. What's the depreciable life of the asset? How much is it going to cost you to get the capital to invest in that asset? Once that's all determined, then you determine a cash flow that's going to be generated off that investment over time. And cash flow is not only revenue and expenses, but also working capital, depreciation, salvage value at the end of the life of the asset. And then once all that information is gathered, we do a return analysis, the 4 methods of determining a return on an asset in dollars, in percent, in a ratio, and in years. Once that is all done, we verify the accuracy or the reliability of that information by doing 2 different types of risk analysis, scenario and sensitivity. And that's the topic of this video in week 5 today. Remember, one of the very first things you do in a capital budget analysis is determine what it costs you to get the money. And that cost is driven by 2 main areas. What's the current makeup of your capital structure in your company? In other words, how much of your company is financed by debt and how much of the company is financed by equity? And then once you understand and know that capital structure, then you determine, all right, what is it costing us after taxes on our debt? And what is the required rate of return of our equity investors for our company? And that required rate of return is based on the risk in the markets, both risk-free rate and average market rates in relationship to the beta or the risk of your particular company. And put all that together in the capital asset pricing model, you get your required rate of return for your stockholders. Combine those based on the capital structure percentages, you get your cost of capital or your discount rate or the cost of money to use in your analysis. And we looked at the base case analysis last week, where the base case is putting together a series of variables to determine the net cash flow generated off the investment. And that series of cash flows is basically putting together an income statement, net income, revenues minus expenses. Now, what makes up expenses is, you need to know a little bit of accounting. A variable cost is an expense that stays the same per unit, no matter how many units you are producing. But as you produce more units, or whatever the output of units is, that's the dollar-driven amount of the variable costs. Fixed costs are the direct opposite. Fixed cost in total dollars stay the same. If you produce more units or less units, that means nothing. Those costs are always the same. We also include inflation. Inflation is always indicated in revenue, in variable costs, and in fixed costs. So whatever the inflation rates given in the problem, you have to account for those in the subsequent years beyond year 1 of your analysis. Speaking of years, this is a 10-year analysis based on the depreciable life of this $1 million investment in an asset. The depreciation tables say it's a 10-year life, thus the project analysis and the project life is for 10 years. Once we determine our net income, then we have to determine the other cash items involved in producing or projecting net project cash flow. One is the salvage value. How much you anticipate getting at the end of the depreciable life of the asset, what would be the salvage or scrap value of that. Since you always fully depreciate that asset over its life, that means that salvage value is a gain on the disposal of the asset. So you have to take your tax out of that to determine your salvage value cash flow in the final year of this asset. The salvage value in this problem was $50,000. The after-tax cash in year 10 is $35,000. Then you add back into depreciation because that's an expense that is non-cash. So you add that expense back in. Then you take into account the working capital. Working capital is additional working capital that you need to manage this investment. And the working capital is calculated as taking a percent of the next year's sales. 12% of next year's sales. 12% of next year's sales. 12% of next year's sales, and so on. Where you always add back the accumulated amount of working capital in the final year, because the project is now, its depreciable life and its financial life are over. Thus, we add all that back in, and the net effect of working capital and cash flow is 0 over the life of the project, but you're properly recording cash going out or coming back in during its life. And from that, we determined our discounted cash flow by using our working capital or our cost of capital rate that we determined earlier. We determine our internal rate of return by taking the entire year 0 through year 10 of the cash flow, determining what that is in interest or in a percentage. We determine the relationship of discounted cash flow to the investment in the profitability ratio or index. And we determine how long does it take us to pay back the $1,060,000 of this investment. And in this case, it takes us a little bit under 5 years. That's the base analysis. Well, then the next phase of this, which gets a little bit more trickier, but then not really, is just looking at other alternatives to review this decision making. One such analysis is what is called the scenario analysis. And what the scenario analysis, this is in chapter 11, indicates is what if we change the level of output of units sold during the life of this project? Our base case, our original plan was 25,000. But what if we say this is going to be a strong venture or a strong economy, and we can sell 35,000 units a year? Also, vice versa. What if we run into an economic slowdown or a weakness in our product in the market? And let's say we can sell only 12,500 units. All else being the same, no changes in expenses. What does that how does that affect our profitability, our net present value? And to add another layer to that analysis, like a lot of analysis in corporate business, is what are the likelihood of these occurring, the probability. This is a whole nother analysis to itself, but we are given this probability as a variable in our study. So 50% chance of having our base case analysis output, 25,000 units, a 25% chance of having stronger units sold every year, 35,000, and a 25% chance that we're going to have 12,500 units or a weaker sales of this product. And what we're doing here is by these probabilities of these scenarios, we're kind of determining a weighted average of profitability based on the likelihood of those probabilities. So we take the NPV of 25,000 units, 35,000 units, and 12,500 units, and we weight them by the probability, and we get it overall. So in the base case, we're planning on making $440,092 of net present value over the life of the investment of 10 years. Taking a look at the scenario analysis of possible alternatives to output, we're still going to make, based on the probabilities, a little bit over 400,000. So the risk of changing in outputs is not that bad. But what the good thing about this is for strategic decision making, and this has to do with our case number 4 or our last case when we're going to be writing a summary or interpretation of a capital budget analysis, is that if we do have a dramatic drop in the weakness in our product in the market, we are going to lose money. So if we see those product sales levels as the actual numbers come in and year out during the 10-year life of that project, and we see sales dropping to the 12,500 level, we know we're going to start losing money. It gives us an indicator of when we are beginning in trouble on this project, which can be good for correcting things as the life of the project goes on. So not only is the base case and the scenario analysis an indicator of what we think is going to happen based on all different variables and alternatives, but also it gives us a budget review or a comparison as the actual numbers come in after every year, comparing to what we planned and how were those plans right on, or if they were off, what can we do about making that fixable? Management, MBA management at its perfectness or perfect MBA strategic balance. We use the plan, compare it to the real numbers as they come in, and adjust our management strategy accordingly as those numbers come in. The second part of the risk analysis is a little bit more technical, a little bit more complex. It's changing specific variables one at a time, not all three, not two at a time, one at a time. And how does one change in a variable affect the profitability of our product? So we have three variables here. So we take a look at three different analyses. Selling price per unit, which originally was planned at $20 a unit. The variable cost per unit, which was originally planned at $8 a unit, and the total fixed cost of $50,000, what that was originally planned. Then if we stick these numbers into our base analysis and change them by reducing selling price by 15%, reducing it by 10, 5, increasing it, we see our profitability levels at those various just with that change in that one variable, the selling price per unit. So we just change this variable right here and see how that affects our profitability. And that's what we did with these numbers here. Then we put everything back to normal, and then we take a look at changes in the cost of variable costs, reducing variable costs, increasing variable costs only, nothing else, and how that affects our profitability of the project. So we go back to the base case analysis and we change this variable. Everything else stays the same. And then finally, we go to put everything back to where it was as the base analysis, and we change fixed costs, lowering our fixed costs, increasing our fixed costs. You lower your fixed costs, you're going to make more money. You increase your fixed costs, you're going to make less money. And how does that compare as an individual variable? And we notice how they compare, or the sensitivity of those variables, by looking at it two ways. The range of the deltas in NPV. Notice the range from top to bottom is 730,000 compared to 291 and 70. So that naturally, the revenue generating variable has the greatest sensitivity to change. And that is also pointed out in the graph or chart of those lines. Notice how steep this line is compared to the variable cost steepness and the fixed cost steepness. It shows us how sensitive that variable is. So if let's say we're not selling 25,000 units a year, and we want to maintain 25,000 units a year. In order to do that, maybe we have to sell at a lower price. This gives us an indicator of the delta of selling price per unit and how that affects the outcome of the profit. In the base case, we're making $440,000. If we cut our revenue and by 15% and still be able to sell 25,000 units, but we're only generating less revenue, we're only barely making money on the project. So it gives us different strategic alternatives to changes as the project goes forward. And this chart is just another way of showing these ranges. So what all this means is we're taking a look at a company making a decision to invest in a new building, a piece of equipment, a new factory, a new product in another country, and put together all the variables of how much we're investing, how much we're trying to sell, what's the salvage value of that investment over what depreciable life, what are the variables of sales, expenses, taxes? What is our project cash flow? Are we making an adequate return? And then comparing that adequate return to different changes in our base analysis to determine alternatives, good or bad. And that's the process that we're doing here in this capital budgeting analysis over these last 2 weeks, 4 and 5, and what you're summarizing in case number 2. And that's what I want you to do. So I've given you a sample, an actual spreadsheet to fill in, but you have to put together the numbers and the equations or functions. Here is an actual sample that you have that you can use as a basis for making your answers. And I'm looking for you to just crunch the numbers. Do the full analysis. I'm not asking, the only interpretation I'm asking you is a yes or no, whether you think the project is worthy. That's it. Later on in our class, I'm going to be asking you to write an interpretation of an analysis like this, but we'll talk more about that later. Just crunch the numbers for this week. That's what I want you to do. And understand what these numbers are telling you and feel comfortable working with a spreadsheet to get this information correct. That's the nature of our assessment in case number 2. So this is where we stand heading into week 6 when talking about financial statements, which is, again, some more number crunching, but in a good sort of way. It helps us understand what our company is all about, both in trend analysis, what has happened, and forecasting into the future, chapters 3 and 12. And we'll talk about that in the coming week. So have a great rest of the weekend, everybody. Any questions on case 2, please let me know, and I'll talk to you next time. Have a great week. Bye-bye.